The performance of the stock market is somewhat tied to the performance of the economy. If the economy does well, the stock market tends to equally perform well. And if the economy goes on a downturn, the stock market is likely to also undertake a downward trend. So in this video, I want to talk about unlocking the secret of economic indicators for stock market success. When the economy succeeds, the market will equally succeed. I want to consider these particular uh, points in the course of this video. Number one is gross domestic product. Gross domestic product, the GDP. GDP measures the total economic output of a country. So a growing GDP actually signals an expanding economy. This expansion in the economy tends to boost corporate profits, while a shrinking GDP is actually an indication of an economy in recession. And once the economy goes on a recession, we discover that it will affect the performance of the stock market negatively. Number two is unemployment rate. The rate of unemployment. This indicator reflects the percentage of the workforce that actually, seeking for jobs but are unable to find employment. Higher unemployment suggests economic distress, and not only that, it tends to reduce consumer spending, and that will negatively affect the prices of stocks in the market because when consumers spend, uh, they spend a huge amount of money that will translate to corporate profits, and that will equally cause the stock markets to take a northward trajectory, whereas low unemployment typically signals you know uh, low unemployment signals the fact that the economy is strong, and a strong economy will definitely result in better stock market performance. Number three is consumer price index. Consumer price index actually tracks inflation by measuring the average change, in prices paid by consumers for goods and services. You discover that the moderate inflation suggests a growing economy, while high inflation can lead to a higher interest rate and decreased purchasing power, potentially hurting stock prices. Whenever there's a decrease in the purchasing power, you discover that it will affect companies' turnover, revenue, and sales. And once these factors are affected, definitely companies' profit will equally take a hit, and that will then result, to a lower earning per shares. And once there is a dwindling in earning per shares, you discover that stock price will then nosedive accordingly. Number four is interest rate. When we talk about interest rate, these particular rates actually are set by central banks. Interest rate affects borrowing costs. Lower interest rates will encouraging borrowing at a cheaper rate, and this will stimulate economic growth. And once the economy grows, it will affect the stock price accordingly. So higher interest rate can slow down growth by making borrowing more expensive, which may negatively impact on the stock market because when the rate of borrowing is not as high as expected because of the higher interest rate, that will curtail productivity in the economy. It will then equally curtail rate of spending, and once it affects rate of spending, you discover that corporate profit will then be affected negatively, and share price will then be forced to go down. Number 5 is a consumer confidence index. Consumer confidence index. This index, gauges consumer sentiment about the economy. So high consumer confidence encourages spending, which will in turn, boost corporate profits and stock prices. And so low consumer confidence can signal economic concerns, leading to a decrease in stock market performance. You discover that the overall performance of the market is a function of how, confidence, consumers are when it comes to the fact that they would be able to have higher wages, higher returns on their businesses, and that would catapult, that would result into higher level of spending because of the renewed confidence in the economy. Please subscribe to this channel and don't forget to like this video. Number 6 is retail sales. Retail sales data reflects consumer spending. So a major drive, these consumer, retail sales, kind of would affect the economy somehow, because a major drive in economic growth will translate into higher spending, and higher spending will as well, influence the kind of same store sales, year in year out. And so strong research usually indicates a healthy economy. Whenever there's an increase in retail sales, it indicates that the economy is in an upward trajectory. It benefits stocks in the process, especially in the retail sector. Weak retail sales suggest reduced economic spending, which may negatively impact stock prices. Number 7 is manufacturing indexes. Manufacturing indexes. So in this context, discover that the Purchasing Managers Index measures economic health in the manufacturing sector. A purchasing index above 50 signals growth, while the manufacturing index below 50 indicates contraction. And so a strong manufacturing sector supports economic growth and rising stock prices, while a decline can lead to lower stock prices. Generally, when companies spend money, you discover that they tend to expand their market share, and the market share expands, and new businesses comes in. You discover that there will be that particular sales, increased revenue, and increased turnover. And this particular manufacturing index will indicate the health of the economy. Not only that, number 8, you have corporate earning reports. When it comes to corporate earning reports, corporate earnings are a direct reflection of the company's financial health. If you want to measure, a company's financial health, and you are asked to pick a single factor that determines how healthy, a company is, you would then need to pick or check the company's earnings. It's an earnings report. So strong earnings lead to higher stock prices, while disappointing earnings can cause stock prices to fall. And so earning reports also provide insight into broader economic conditions and the market sentiments. And so the stock price, the singular most important factor that affects stock price is company's earnings. Number nine is housing market data. Housing market data here, when it comes to this particular factor, housing markets are indicators such as, home sales and, housing starts provides insight into consumer confidence and economic activities. A strong housing market typically signals economic growth, you know, and that can positively affect the stock markets, especially in sectors like construction as well as real estate. So the more people, when people buy homes, in an increased rate, it indicates that the economy is doing very well. The economy, is on a kind of upward traction. It's gaining upward traction. And number 10 is inflation. And so rising inflation can erode purchasing power and impact corporate profits. Stock may react negatively, in an environment of high inflation. Because when inflation hits the economy, people will no longer be able to purchase the quantity of goods they are used to purchasing because of the lack of purchasing power, and this would affect companies' turnover, companies' revenue, and once revenue and turnover kind of is affected, you discover that definitely the profit, the bottom line of the company will then equally be influenced. And before you understand, you discover that earnings will drop, and stock price will then equally drop accordingly. And so these indicators help investors understand the state of the economy, predict market trends, and as well as make informed investment decisions. By monitoring these indicators, investors can adjust their strategies to align with changing economic realities. And I want to reiterate the fact that the economy moves in tandem with the stock market. If the economy is up, the stock market will be up. If the economy is down, the stock market will equally nosedive. So the two are kind of inseparable when it comes to performance.